All right, let's keep this China train rolling along as we're in search of some Chinese companies to invest in. In the last episode, we looked at Alibaba in quite some detail, and today we're going to look at their biggest rival, Tencent. If you are new, welcome to my channel. My videos are about investments that anyone in the world can make. Now today I'm just going to focus on the company Tencent, but if you want more of an overview of investing in China, well, I made an episode about this a few episodes ago, which I'll put at the end screen of this video. Now, just like Alibaba, Tencent is a giant tech company based in China. Tencent is the world's largest video game company. It's also one of the largest social media companies, and it's a venture capital and investment company, one of the biggest of those in the world as well. Tencent are actually involved in hundreds of different areas, and they're actually a strong player in most of these areas as well. Here are some examples. So they're heavily involved in music with Tencent Music Entertainment, which has 120 million paying subscribers, which is about the same as Spotify. Gaming, think like Fortnite, League of Legends, Call of Duty, and really they're the heart of eSports. Social media, think WeChat with 1 billion users. They're also involved in banking, insurance, movie production, virtual reality, ride sharing, real estate, space technology. They really have their fingers in every pie. It is truly a mega conglomerate. Tencent own 56% of the social media market in China. This is where they generate a large amount of their ad revenue from. It is similar in a way to Facebook. It's hard to think of a company to compare it to that you might be more familiar with. Tencent is kind of like part Facebook, part Google, part Tesla, and part EA Sports. Now, I see this as mostly positive because Tencent have a lot of diversification in lots of different areas. If one area doesn't look so promising, well, they just shift their focus to one of the other areas that is growing really fast. From an investor's point of view, having diversified streams of revenue and different opportunities for growth makes this a very stable investment for us. For example, if the government were to change the rules for Google, for example, and allow Google to enter the Chinese marketplace, well, the search engine part of Tencent's business would be affected, but it would definitely not kill the company. They would have so many other streams of revenue, so it would be a little bit of a setback, but it definitely wouldn't be devastating. Whereas if they were just a search engine, well, they've got a chance they could be crushed by Google, kind of like what happened to Yahoo back in the early 2000s. But with great diversification comes the problem whether they can actually manage all of these different areas. And what is it that they're actually good at? Are they good at gaming? Are they good at social media? Are they into music? There are literally hundreds of industries that they're involved in. It's just a big juggling act. Because at the end of the day, that's really all they are. They're just this mega conglomerate that they just buy up all these different companies and put them under Tencent. So if we want to see them continue to grow into the future, we want to see that cash pile get bigger and bigger so they can keep doing it. Now, WeChat and gaming are the most important parts of their business. WeChat is not just a messaging platform. It's also online banking, it's stock trading, you can even buy movie tickets on there. It also integrates with Didi, which is like the Uber of China, where you can just order a taxi on the app. And many companies are actually selling their products directly through WeChat as well. And Tencent is the heart of the eSports revolution. It's not just the massive growth in people playing their games, it's actually the growth in viewers watching people play their games. In 2017, the total viewers of eSports reached 335 million people, to a predicted, in 2021, 557 million people. And as popularity grows and awareness grows, so does the revenue. These stats clearly show the rapid growth in esports. And even in the USA, where most people would think that traditional sports are more popular, well, esports is second only to the NFL. It beats baseball, basketball, and hockey. Tencent is capitalizing on a new generation of sport fans. All right, now let's talk about some of their problems. Because WeChat is actually a monopoly in the Chinese market, critics are quick to point out that there's a lot of anti-competitive behavior going on. Also, the company is not really described as an innovator, it's rather a bully. Whether that's just buying out the competition or just buying their way into a new market, they really don't have their own unique development pipeline. Okay, now in my opinion, it kind of looks like it's true, but who really cares? If they have the money and the foresight to see a new trend developing, well, I don't think it's a really big problem. Companies have always been doing this and they will continue to do it. I think people just don't like seeing the big companies succeed and all the little companies getting taken over. But hey, I'm a realist and this is the way the world works, so I don't really have a problem with this strategy at all. So just like Alibaba in the previous video, I don't really see any issues with Tencent at this stage, and I'm actually really impressed so far. But if I'm impressed, I bet thousands of investors throughout the world are also impressed. So let's go now see if they're financially strong and make sure they're not too overhyped. Now, there are three key areas to the health of any business. Do they have too much debt? Are they growing? And are they a well-managed company? Now, we want to see the company pass all three of these criteria, but unfortunately, it's a bit more of an art form than it is a science, but I have developed some criteria that we can use to guide us. And I've developed this criteria from studying the legendary investors Warren Buffett, Benjamin Graham, Bill Ackman, and Charlie Munger. Now, this isn't meant to be boring, so just sit back and don't worry about the terminology and just get a feel for what I'm doing. So the first thing we're going to look at is whether they can handle their debt. And it is really important to look over the company's debt, because if the business was to completely stop for some unknown reason, like a crazy government decision or some sort of lockdown happening again, well, with low debt, they're going to be completely fine. So to see if the business can handle its debt, I went through the debt to equity ratio and the current ratio of the business. And for Tencent, as long as it's under 0.7, I'm happy with this. And it has been under 0.7 for a long time. Now, the current ratio is actually a little lower than I would like to see. I normally want to see it above 1.5. Being close to 1 really just means there's not much margin of safety here. I actually think it's a sign that they're being too aggressive. So we can't give them a tick here, but we'll give them a half mark. Now we're going to see if they're growing. And obviously we want to invest in a company that is growing, right? But just 1 to 2 years, well, that's not really going to cut it. We want to see maybe 5, maybe 10 years of consistent growth. So to check for consistent growth, I look at the book value per share, the earnings per share, and the operating cash. Also, if you want more information about what these ratios mean, go back and have a look at my Facebook analysis that I did, where I go into a lot more detail about what these actually mean. And as you can see with the graphs on the screen, there's just great growth numbers here from Tencent. I've also had a look at the expectations for the current quarter, and Tencent are a bit unsure exactly what the numbers will be, but they are expecting big growth from their gaming purchases, but then a drop in advertising revenue. Because they're so diversified, some of their businesses will do really well in the lockdown, and some of them will suffer a lot. So I think this makes Tencent a very stable company. Now let's see if the company is well managed. And we can't obviously go and have a meeting with the management team and just sit in and see what they're talking about. But in the financials, there are some telltale signs that we can see to see whether management are making some good decisions. So I'm going to check for the cash deployed into investing activities, return on equity, the free cash flow, cash on hand, and if they've got a dividend. Now, as you can see here, Tencent are spending most of their operating cash on investing, which is pretty typical of a growth company backing themselves to get bigger and bigger. They're also paying a gigantic dividend. No, I'm joking. It's very tiny. It's pretty much the same as 0. Now, the return on equity is high at about 20. I'm not too concerned that this has been declining over the years. The company is maturing, so it's probably to be expected. Anything above 15 is great. Now, these graphs are impressive to me. See, Tencent are growing their cash reserves so that they can deploy this money into new opportunities and expansion plans. They will be able to take on the future in a really good position. Now, is Tencent a good company to put onto my watch list? Now let's go and work out our buy up to prices and see what the share market is offering us. If you want a copy of the exact same calculator that I'm using, well, you can download it in the description below, and it's completely free. And I'm going to use it to show you how to value Tencent right now. So what we're going to do first is we're going to input the growth rate for years 1 to 5 and then years 6 to 10. Now the analysts are saying it's 20% growth. Now I like to be a little bit more conservative, and I've put this at 17 and 14, as you can see here. My ROI goal is 20%. Now, I actually want 15%, but then 20% gives me a margin of safety. The multiple I could sell it for after 10 years is 15, because it's such a good company. And the operating cash flow, maintenance capex, now I've found this information before. So it's 21 billion, and the shares outstanding is about 9.6 billion. If you want to know where I found these numbers from, I've done a full tutorial video as well, so make sure you go back and watch that. It's called How to Find Intrinsic Value. So, for Tencent in particular, it says I want to buy it at $35.70. Now that's in US dollars. Now we need to turn that into Hong Kong dollars, because this is listed on the Hong Kong Stock Exchange. So I've already done that calculation here, and it's 277 Hong Kong dollars. So if we move down to my second buy point, I've got more conservative numbers for the growth rates, a little bigger margin of safety, and the rest of the numbers stay the same. And my second buy price is 217 Hong Kong dollars. Just here. Now my third buy is just more of a hoping buy, but if we get this point, we'd have to be buying aggressively. So I was using a lot more conservative numbers here. So I've got 13, 10%, 30% is a huge margin of safety. Same numbers for everything else. And if it ever got to 125 Hong Kong dollars, well, that would be crazy. Now, if I jump over to Yahoo Finance and look at the current share price, it's 432 Hong Kong dollars. So that's significantly higher than even my first buy point. Well, unfortunately, just like we saw with Alibaba, Tencent, although a great company, the prices are just too high right now. But I would happily be an investor if the price was to get to 277 Hong Kong dollars. Okay, let me summarize everything about Tencent so far. Look, I think the most important thing that we've discovered today is that Tencent is a great company and it's performing really well. I think they are a little aggressive with their current ratio, but it isn't too bad. It's not a big red flag. And unfortunately, the share price is just too high, and we'd have to see about a 30% fall from the current levels it is now, which for such a good company probably unlikely. But I'm definitely adding Tencent to the list of companies that I'm going to be watching. They are a dominant social media player in China. They are in the box seat for the future of eSports. China is also a huge market. They are investing in the future. They have multiple different revenue streams and their finances are solid. Now, Chinese companies don't have the strongest reputation when it comes to financial reporting. So I'm definitely not going to go out there and pay anything more than what I think fair value is with a good margin of safety. But in saying that, I will definitely be jumping in if the share price reaches my buy up to price, and then I go back and check the financials just to make sure nothing is wrong. I definitely want to be a buyer then. And until then, I'll keep looking for investment opportunities inside of China. And with Alibaba and Tencent, I now have 2 Chinese companies that I do really like. So make sure you hit subscribe to follow me along to see if I can find some more. I hope you enjoyed my analysis, and I will see you in the next video.